I woke up at 4 in the morning to a frantic text from a buddy of mine who handles institutional capital, and his message was simple. We are completely cooked. Man. He sent me a video clip of a massive oil refinery fire raging in the distance, a place called Ryazan southeast of Moscow, where multiple drones had just completely leveled the primary distillation towers. When you see a multi-billion-dollar energy facility lighting up the pre-dawn sky like a violent volcanic eruption, you realize that the physical supply chains undergirding the global economy aren't just stretching, they are actively snapping in real time. And the truly wild part of that story isn't even the explosion itself. It is the fact that it started literally raining crude oil down on the local residential streets, leaving regular everyday people standing outside in their pajamas completely covered in black soot. That image of regular citizens watching their predictable world evaporate while oil literally pours from the sky stayed with me all day, because it is the perfect visual metaphor for what is happening to the global financial system right now. We are sitting in a moment where the surface layer of our economy looks normal, but underneath the hood, the structural engines are catching fire and raining risk down on your bank account. Let us be completely honest with each other right from the absolute jump here. The mainstream financial media is completely lying to your face about the structural integrity of your purchasing power. They want you to believe that everything is a localized, temporary anomaly, but the macroeconomic data hitting the tape over the last 48 hours tells a deeply dangerous story. Look at what is happening over in the global energy corridors, where the crucial Strait of Hormuz has now been functionally locked down for over 2.5 months straight. The total volume of global oil flow is choking out. A full third of the planet's emergency strategic stockpiles have already been completely flushed down the drain just to keep retail gas prices from hitting double digits. And the supply chain shocks are deepening every single hour. And right on cue, the newest domestic wholesale inflation metrics just dropped on the wire, and they are genuinely panic-inducing for anyone who understands basic math. The official producer price index for the month of April came in at a staggering 1.4% increase in a single 30-day window, which is almost triple the standard consensus expectations of the smartest analysts on Wall Street. To find a single monthly wholesale inflation spike that massive, you literally have to cast your mind all the way back to the dark days of March of 22. And if you strip out the volatile food and energy sectors to look at the core data, the market was expecting a tiny increase of 0.3%. But we got slammed with a full 1% jump instead. What is sitting upstream in the wholesale pipeline today is going to land directly in your grocery bills and your home utility statements. 2 short months from now, like a financial sledgehammer. Meanwhile, everyday consumer prices are accelerating out of control, with the latest CPI printing at 3.8% year-over-year, driven by gasoline spiking 28% and grocery costs jumping at the fastest monthly rate in 4 long years. Oh shit. And the absolute most horrifying part of this entire sequence is that real American wages just fell 0.3% year-over-year, marking the first official annual decline in real worker purchasing power in 3 years. So while the prices of basic human survival are ripping through the roof, the actual value of the paper money you bring home for your labor is actively shrinking. This is the textbook definition of a vicious economic cycle, and it is happening because we have officially passed the point of no return under a phenomenon known as fiscal dominance. If you remember our deep dive into the core terms of modern macroeconomics, fiscal dominance happens when a government's total accumulated debt and deficit trajectory becomes so monstrously massive that they completely neutralize the traditional tools of central bank monetary policy. In a normal, healthy economic environment, the Federal Reserve can easily raise its short-term interest rates to cool down an overheating system, because higher borrowing costs force businesses to stop expanding and force consumers to save cash instead of spending it. But under the weight of $39 trillion in national debt, that traditional monetary transmission mechanism is completely broken. The global bond market looks at the massive risk premium required to hold American debt under its current chaotic management, and the market simply decides that the United States is becoming an unreliable credit risk on the world stage. When the world's most historic sovereign borrower starts behaving like a reckless deadbeat, the international market takes immediate notice and demands a massive premium to lend them cash. That is why the 30-year U.S. Treasury bond yield just went screaming past 5.1%, hitting levels we haven't witnessed since the absolute peak of the great financial crisis back in 2009. So, the elegant mainstream narrative that some new leadership inside the Federal Reserve is going to calmly walk into the building, snap their fingers, and bring interest rates tumbling down to save your home mortgage is completely preposterous. The market controls the long end of the yield curve, And right now, the smart institutional money is actively pricing in a permanent systemic crisis. You see it in the corporate boardrooms where Fortune 500 companies are no longer using their capital to raise worker wages or invest in productive new business facilities. Instead, they are looking at a tapped-out consumer base, taking their massive tax cuts and lighter regulatory cash piles, and funneling close to $1 trillion into buying back their own stock to insulate their wealthy shareholders. The elite individual investors sitting at the absolute top of the financial ladder see the writing on the wall, and they are quietly moving their massive capital fortunes straight out of circulation and directly into cash reserves and deep short positions. When the smartest money in the room exits the playing field to sit on the sidelines and wait for the fire to stop burning, it removes vital liquidity from the productive economy. That capital flight is deeply contractionary for the asset markets regular people rely on, but simultaneously hyper-inflationary for the daily goods and services you need to live. It is the absolute worst of all possible macroeconomic worlds for everyday working families. And it means the historical shield you thought would protect your savings is no longer reliable. So, let us look directly at the actual data and talk about how we handle our personal finance strategy when the global matrix begins to fracture like this. I am telling you right now, this is not the time to play cowboy with your capital or chase hyper. Speculative tech bubbles based on pure hype. When the macro wind is blowing this hard against the system, your absolute number one priority must shift from aggressive capital appreciation to ironclad wealth protection. The very first strategic habit you need to deploy is the aggressive expansion of your liquid emergency cash reserves, held entirely outside of volatile market instruments. Now, I know exactly what some of the hyper-optimized finance gurus on the internet will say to that advice. They will tell you that holding pure cash means voluntarily losing 3 to 4% of your purchasing power to the inflation monster every single year. And mathematically, they are completely right about the inflation drag. But what they completely fail to understand is that in a high-risk macro environment, cash is not just an asset class. Cash is an option contract on reality. Having a deep, liquid cash cushion gives you the psychological and operational leverage to survive a sudden personal income shock or a massive stock market correction, without being forced to liquidate your long-term investments at the absolute bottom of the cycle. My personal hard-charging rule for my own finances right now is to maintain a full 12 months of baseline living expenses completely locked away in a high-yield savings account or ultra-short-term government cash management bills. That money is my personal financial bunker, and it stays entirely untouched regardless of what the stock market does on any given Tuesday. Once your liquid defensive bunker is completely built and fortified, you can then look at your long-term wealth accumulation engine with total clarity and emotional detachment. For the core wealth building segment of my portfolio, I do not waste a single second of my day trying to time the perfect entry points of individual corporate stocks or listening to random talking heads on cable news. Instead, I rely entirely on the boring mechanical discipline of biweekly dollar cost, averaging directly into broad market index funds like VU and VTI. Every single time my corporate paycheck hits my bank account, a fixed percentage of that capital is instantly and automatically swept into these diversified funds before I ever even have a chance to see it or think about spending it. When you dollar cost average mechanically every 2 weeks, you completely remove human emotion, fear, and greed from your investment strategy. If the stock market drops 5% next week because of a new supply chain shock or a geopolitical escalation, I do not panic. I simply celebrate because my automatic bi-weekly transfer is going to acquire more shares of the finest companies on earth at a steep discount. And if the market rips higher, the capital value of my existing holdings expands along with it. By spreading your purchases out evenly over long horizons, you mathematically smooth out the terrifying short-term volatility of the market, and you ensure that your personal net worth grows in alignment with the long-term productive capacity of the entire global economy. But to survive this macro storm with your sanity completely intact, you also have to understand the deeper psychological traps that the market sets for your brain during a prolonged crisis. When the headlines are screaming about war, inflation, collapsing bond yields, and political chaos every single day, your brain's ancient survival mechanisms naturally fire up and scream at you to do something drastic to protect your territory. This psychological panic is the exact moment when retail investors make catastrophic, unforced errors, like selling their entire retirement portfolio at a massive loss right before a major market rebound, or chasing highly speculative alternative assets at the absolute peak of a hype cycle. You have to realize that the financial markets are explicitly designed to transfer wealth from the impatient, emotional operators over to the patient, disciplined, mechanical stackers. Your defensive mindset must become completely unshakable, treating the daily noise of the financial world as nothing more than background static while you execute your predefined strategy with cold, calculated precision. Think of your automated personal finance system as your ultimate structural shield against a chaotic world. The global geopolitical stage can descend into complete madness, the international shipping lanes can lock down entirely, and the political elite in Washington can continue to completely torch the credibility of the national currency dollar by dollar. But as long as you maintain a deep cash cushion to protect your daily life, avoid toxic high-interest consumer debt like the absolute plague, and continuously accumulate productive global assets through automatic dollar-cost averaging, you possess a personal economic shield that no central banker can ever truly take away from you. You are no longer a passive victim of the macroeconomic cycle. You become an active defender of your own financial destiny. I am going to keep tracking these wholesale numbers and global market movements every single week as this macro landscape continues to rapidly shift under our feet. We don't take a single dime of corporate sponsorship money or run manipulative ads on this channel because I want this data to remain completely independent and accurate for the community. This independent work belongs entirely to the defenders who help keep the lights burning in this studio every single day. Thank you for standing in the arena with me. Look out for your capital and stay disciplined out there. Peace.